Hi, Danny from the Field Group. In today's topic, we're going to be talking about trusts. So trusts are an obligation imposed on a person, in this case a trustee, to hold property or assets for benefit of others, being beneficiaries. Trust is formed, the solicitor draws up a trust deed, which is a document that sort of sets out the rules and how the trust will be administered. And it becomes the law as to how the trust is going to run. There's two types of trust. There's a discretionary trust, which by the word itself means that the trustee has discretion as to who receives the capital and income within the family group. And the second type's a unit trust, which has a lockdown fixed percentage of units held, which determines the percentage of capital and income. So if you own 50% of the units, you would get 50% of the income. So a trust can hold assets. They might be shares, they could be cash, could be property. They also can be used as a legal vehicle to shift profits from one trading entity, maybe away to another entity to protect it. It can help with asset protection. And obviously they can also run a business. So we often have difficulties explaining to clients the relationship of the trust and the trustee. A trust, unlike a company, is not a separate legal entity. It's the trustee that is the legal entity. So it's the trustee that owns the assets and enters into all contracts, whether it to be buy property or get finance or whatever it be, on behalf of the trust. So it's the trustee that can be sued. And if it is sued, the trustee can use the trust assets to pay any debt. And if the trust hasn't got enough assets, it's then the trustee that would have to use their own assets to pay the balance. And that's where we quite often put a trustee company in place, because then that would limit that liability away from the individual. So why would we use a trust? So, as just mentioned, the reduced liability where a trustee company is in place is one main reason. Another reason is that we can protect the assets that are in the trust away from the individuals. If the individuals have got risk in their lives, those assets in the trust are protected. The main reason I feel is for trust is the flexibility of asset and income distribution. So where you're running a business, it's mum and dad, and you want to have variations in the way the income's distributed to be able to pick and choose. Trust perfect. So it might be that mum or dad might be earning variable amounts in other jobs, and the trust allows us to maximise the tax position by giving one of mum or dad more income than the other to keep them even. Might be that mum stops work for family reasons, to have some kids, and therefore we can direct a lot more income to mum during that period and keep dad's income down. Also beneficial where you've got adult children who might be studying, you can use them as a beneficiary, save some tax. And similarly, self-funded retiree parents who don't have any reliance on income tests for government pensions and the like, they can be used as a beneficiary. So a trustee can pay tax, but it's very uncommon. We don't see it very often. In most instances, the trustee will distribute all the income of the trust each year to the beneficiaries, and it's the beneficiaries that pay the tax. Where we have two or more independent people or families involved in a business, it would be uncommon and not appropriate to use a discretionary trust, as the trustee has no fixed instructions as to who's to receive the income. It's all discretionary, and therefore one family might benefit more than the other. So in that instance, that's where a unit trust would be more appropriate, as that sets out the percentage of units held and therefore gives the trustee more guidelines as to how that is to be split. Some of the disadvantages of a trust are the initial, they're expensive to set up and complex to administer. Can't distribute losses from a trust, so they're trapped in there until such time that you can either get some other distributions into it, or the business starts making profits and can use them then. Another one is financial institutions. So quite often, and especially in recent times on the back of some of the changes in the banking world recently, we're finding it's getting more and more difficult for the banks to understand how trusts work and the flow of income. So if you're buying assets within the trust, or maybe it's personally, but you're getting your income from the trust, it's harder for them to understand the flow of money where it's discretionary, and we're seeing clients find it a bit more difficult to borrow money as a result. Retain profits. So unlike a company that can retain profits and pay tax on those profits, while a trustee can do that, it's very rare, and therefore we find that we don't set up businesses in trusts that are going to retain a lot of money, so they might have high profits. It's more for lower end profits where the individuals can pay all the tax. But we do have those situations where a client might get a tax bill and feel they haven't got the income from the trust to justify that bill, and that's because the trust assets have tied up some of that money, and because the trust has to distribute all the income, the cash might not follow that income, and therefore it can feel like the beneficiaries pay more tax than maybe they feel they should. Another little intricacy with trusts is the 80-year vesting period. So when a trust's set up with that deed, it'll have a vestment date, which means that it needs to cease. It's 80 years, so it seems like a long time, but we are starting to see some dates creep up that were set up. The trust was set up quite a while ago, so we've got to get some guidelines around that because it's going to cause some issues. Some of the requirements when you're setting up a trust is the trustee would need to go and get a tax file number for the trust, and then lodge an annual tax return every year. And one other tip would be, if you are setting up a unit trust, we'd recommend a unit holders agreement that can set out some of the terms and the rules of the trust, and if someone wants to exit, how that's going to work. So we hope this helps you understand a little bit about trusts and why they're a popular vehicle, especially with the flexibility of assets and income distribution for those smaller businesses that would benefit from that. Thanks.